This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company.
So I'll just get started. Hey, good evening, everybody, and thank you for attending, and our thanks to Jeff and MetaStock for their support. Jeff, I've got the sound off, so I'll be able to see you on the chat, but I won't be able to hear you for the time being, if that's okay. We're getting started. So MarketTamer.com, thanks for the introduction. Very simply, we teach retail investors how to become profitable trading and investing with stock and options. While we offer an overall education in this area, we focus on teaching 3 systems of trading and adjustments that have proven successful and profitable under all market conditions. The first we call the Wheel of Profit. And guys, excuse me for a second, it's going to take me a minute to get set here on my controls. I know there's a bit of a delay. So the agenda today is we're just going to chat a little bit about Market Tamer, and a little bit, I promise you. A quick review of Condors and Calendars, the general rules for the trades, trade setup, entries, exits, and adjustments. And keep your questions for the end. I'm not going to be able to do the presentation and answer in the chat. So if you keep your questions till the end, we'll be able to take care of everybody. And I can stay longer if need be. So the first trading system that we use is called the Wheel of Profit. It's a stock-based strategy that uses options to buy stocks at a discount, to insure them against a loss, and to create income. The second strategy is a short-term trading strategy from our trading ideas section. And this is for day traders and those that can spend a few hours a day at their computer. It's extremely effective, remarkably simple. And not only do we teach the system, we actually give you the trades. And the third strategy is what we'll talk about tonight, rule-based income trading using iron condors and double calendars. Now, just a bit of a background. I'm a directionally challenged trader. I buy stocks, they go down. I sell stocks, they go up, and I'm not kidding. It's brutal. My friends have called me the perfect indicator. And what's that? It's one that's always wrong. So I started income trading, condors, calendars, risk butterflies, and whatnot. But after a few months of profits, I would give them back in a month when the market trended strongly. So I began to borrow from a number of different strategies to develop a style of adjustments and rules that would make up for my directional shortcomings. Since the markets generally go sideways for a greater period than they trend, I wanted strategies that optimized a channeling market, but could also force me to become directional when need be, with a decent probability of success and with a risk profile that I could handle. So moving on, just a quick background. For those of you who are not familiar with iron condors and double calendars, I'll go through it real quickly. An iron condor is a credit spread. It's basically a combination of a bear call spread and a bull put spread. So one below the market, one above the market, and you sell in the same expiration month. It's a credit spread, so you get money in your account right away, and you just have to write it through to whatever expiration period that you have. A double calendar is a combination of 2 calendars, both a call calendar and a put calendar. That's generally the way I do it, but you could go all puts and all calls if you want to. But it's in a classical sense, you're looking at a call calendar above the market, and then a put calendar below the market. You sell a short call in the front month, and then you buy a long call in the far month. That month is typically the next month. So if you were to sell a short call and put in May, you'd buy the Junes. But in certain situations, especially when volatility is very low, you can go further out and do what I call a campaign calendar, where maybe you might sell the Mays and buy July or September or something like that. And the advantage to that is well, they're numerous, and we'll go through them later. I'm hearing a bad echo. Not sure how to fix it. Let me see what I can do here. Okay, so the iron condor entry. Typically, we want to enter an iron condor when we have mid to high volatility. In a low volatility environment, the risk reward, I find, is just not good enough. You can do them 12 months out of the year without a problem. But if you want an edge, then you want to go in a high volatility environment. Generally, you sell the options one standard deviation away from the market. There's all kinds of calculators out there that will help you do it. But look for the deltas of the sold options to be in the low teens. Plus or minus 10% is probably a good one. The long options would be purchased 1 to 2 strikes from the short options. So if it's like an Apple or a ISRG or a Goog or a Baidu or something like that, you probably want to sell them about 10 points away. That's the next strike. I generally use 20s, but that's because of the directional bias that I have. The position delta should be close to 0 when you put these on. So here's a picture. I'm hoping you can all see that. So basically, this is a iron condor I put on Friday just for the purposes of the discussion tonight. It's on the GLD. I play this quite a bit. I feel real comfortable with the long-term value of gold, so it doesn't really scare me to sell puts on these things. I've got these spreads 5 points out. I think that's a pretty good spread on this. And if you look at the bottom where it talks about net requirements and gross requirements and cash flow, in essence, when I put this spread on, I got about $1,000 in my account. My risk is about $9,000, so it's roughly a 10% profit if I don't have to adjust and everything works out well. Also, you'll notice where the arrow is, we've got a delta of about a -8. I generally don't adjust anything to the delta is around a minus or a plus 100, and then there's other rules that we'll go through later. For those of you who haven't seen a risk graph before, this is just a picture, a graphical viewpoint of what we just saw, the condor. You'll see there the profit margin, the probability of profit, how this trade will change over time as the stock moves up to down, and then where your break-evens are and your maximum losses on either side of the screen. This is important to remember how this is shaped, because when you see the adjustments later, you'll see how this risk graph changes, and that's often used as a guide, and I certainly use it as a guide moving forward with my trades. So here's a chart of gold. This is as of Friday. It's on an uptrend for sure. It is above the 5-day moving average, which is something that we use quite a bit. We've got trend line support, moving average support. We've got a bit of a volume divergence. And we've got support at 106 and resistance at 114. To me, that looks like pretty major support in the near term. Not sure how this stock is going to react to this, or this ETF will. But the volume thing doesn't scare me too much anymore, because this entire rally that we've seen over the last few months has been on low volume. So maybe this is the new normal. Now, this is another picture of the gold ETF just a couple of days later. If you'll see it went up, it went down a little bit, and then we had a really strong move yesterday, and I think it closed a little bit down today. And I'll show you some of the adjustments that we made here. So on the adjustments, the general rule, and this is mainly on a condor at this point, you have to react when the delta reaches a plus or minus 25. Now, this is the delta of the short call or the short put. This is not position delta. So when you reach 25 plus or minus on those, the puts or the calls, you've got to do something, because at that point in time, if it goes further than 25 deltas, it becomes difficult to adjust in the normal string of things. Typical adjustments is that you'd rebracket, you'd buy back the trade, and you'd sell it again up or down, still using the same initial rules of standard deviation. You can buy it back at a small loss and just leave it there and wait. If the market's going crazy, you can wait and reapply it after a couple of days after things settle down. Or if you put it on in May, let's say, you can roll it out to June, widen your spreads, and you can either break even on that and sometimes even make a profit depending upon how the stock is moving. But for those that doesn't really work for me unless I don't have the cash to, for some reason, to adjust in the manner that I like to. These typical adjustments are very inexpensive, low-cost adjustments, and they work. But you end up spreading